Welcome to Brain Vision.
When it comes to consumption and investment, we're looking at a situation in which consumption is reduced and investment is increased. So how is economic growth affected by this? Well, what we know is that when we increase investment, we also tend to see an increase in economic growth. And this happens because of this new accumulation of capital. So what we see as a result of this is also typically an increase in productivity. Right? We invest in certain things. We're able to invest in labor. We're able to invest in technologies, all of which are able to increase productivity of a nation. And by increasing productivity, we typically tend to see this increase in economic growth and well-being. However, as a result of this increase in investment, we're reducing consumption. So what we're going to see in the short term is that consumers are probably going to be hurt a little bit. We're probably going to see, as a result of this lower level of consumption, we're probably going to see maybe lower profits, lower maybe economic well-being in the sense of people like to consume and now they're not. So we may see some people hurt in the short term overall. However, in the long term, almost every group will probably benefit from this, because if we look at this in the long term, we're going to end up seeing, as a result of this heightened productivity, we'll see lower costs, we'll see higher profits, higher employment, however, we do have to sacrifice something in the short term, and that's going to be these lower levels of consumption. But over time, most people are very likely to benefit from this, so it may be just that the current generation will suffer a little bit. However, future generations are likely to benefit.